Hi, welcome back to Cheryl Trades Leaps. Every time a major geopolitical conflict breaks out, retail traders tend to do the exact same thing. They panic and sell near the bottom. Or they buy too early, get chopped apart in the volatility, and give up right before the rally. Meanwhile, institutional money does something very different, and that's where the real opportunity is. Today, I'm going to walk you through a structured playbook for trading geopolitical crises using Leaps options. This framework has shown up across multiple major conflicts over the past 2 decades, and I'm going to show you when not to buy, when to start entering, and how to scale in so you're positioned when the market stabilizes. Because historically, markets tend to recover once uncertainty starts to fade. Stick around, because the entry trigger I'm going to show you later is the most important part of this entire framework. Before we get into the phases, I want to give you the single most important idea in this video. Most people think markets sell off because of war. That's not exactly what's happening. Markets don't just price war, they price uncertainty about what comes next. Think about it this way. The market doesn't drop simply because conflict begins. It drops because nobody knows the scale, the duration, the economic impact, or how far things could escalate. And that uncertainty, that lack of clarity, is what markets react to most. Here's a good example. During the Iraq War in 2003, markets had already been under pressure before the invasion. Once the invasion actually began, some of that uncertainty started to resolve, and markets soon stabilized and moved higher. So your job as a trader is not to predict whether war happens. Your job is to recognize when uncertainty is peaking and when it starts to fade. That's your edge. Let's break this down into 4 phases. Phase 1. The fear spike. This is the moment when everything feels urgent. And it's also when you should do nothing. Headlines explode. Markets drop sharply. Oil spikes. Volatility jumps. Social media is filled with panic. And this is exactly when you'll hear people shouting, "Buy the dip." Don't. In phase 1, there is no structure. You don't know where the bottom is. Selling pressure hasn't exhausted itself. For example, during the Russia-Ukraine invasion in February 2022, markets were extremely volatile. Stocks even reversed sharply higher intraday on the day of the invasion, but the following days remained unstable before a more durable low formed. That's the key. Volatility doesn't equal a bottom. Your job in phase 1 is simple. Protect your capital. Stay patient. Observe. Phase 2. The whipsaw. This phase is where most traders get trapped. You'll see big red days followed by sharp green rallies, then reversals again. News headlines shift constantly between escalation and de-escalation. This creates 2 common mistakes. First, traders assume a big green day means the bottom is in, and they go all in too early. Second, traders panic out of positions during volatility, right before the market stabilizes. Your approach here should be cautious. You can take a small starter position, around 10 to 20% of your intended size, but your default posture should still be patience. You are waiting for phase 3. Phase 3. Stabilization, your entry zone. This is where the opportunity begins. So how do you know you've reached this phase? Here's the key signal. Bad news stops pushing the market lower. You'll see headlines that would have caused sharp sell-offs earlier, but now the market barely reacts or quickly recovers. This tells you something important. Sellers are becoming exhausted. The market is starting to absorb the risk. On the chart, you'll start to see higher lows forming, the 20-day EMA flattening or turning upward, stronger volume on up days. This is where institutions begin accumulating. Looking back at 2022, markets began finding a more stable footing roughly a couple of weeks after the initial invasion shock, even though headlines were still negative. And that's the key lesson. Markets don't wait for the news to turn positive. They move when uncertainty starts to decrease. This is where you begin entering leaps positions. Phase 4. The relief rally. At this stage, the narrative shifts. It might be de-escalation, stabilization, or simply the market adapting to a new normal. Oil stabilizes. Volatility declines. Growth stocks begin to lead again. This is when your earlier entries start working. Your strategy here is simple: add to strength and let your positions develop. Historically, once uncertainty fades, markets can reprice quickly, and that move often happens faster than most people expect. Historical context. Let's look at a few examples. Russia-Ukraine, 2022. Markets were highly volatile immediately after the invasion. Over the following weeks, they began to stabilize as investors adjusted to the situation. That stabilization phase created opportunities for disciplined entries. Iraq War, 2003. Markets had already been under pressure before the invasion. Once the conflict began and uncertainty started to resolve, markets stabilized and moved higher, even before the war was fully concluded. Israel-Hamas, 2023. The U.S. market reaction was more contained than many expected. Stocks even rose shortly after the initial shock as investors assessed the broader impact, though later moves were also influenced by macro factors like interest rates. Different conflicts, different timelines, but similar behavioral patterns. Your step-by-step playbook. Step 1. Protect capital. If we're in phase 1 or early phase 2, do not go full size. Cash is a position. Step 2. Identify leaders. Focus on strong, high-quality names that were already in uptrends before the crisis. Examples: NVIDIA, Microsoft, Oracle, Tesla, Meta, etc., or CoreWeave. Higher risk, higher reward. Avoid broken charts. Step 3. Entry trigger. You begin buying leaps when the market stops making new lows. Bad news no longer causes significant selling. The 20-day EMA starts to stabilize or turn upward. Stocks begin forming higher lows. When these align, that's your signal. Step 4. Scale in 25% starter position, 25% on confirmation, 50% on breakout. This keeps risk controlled while allowing you to build into strength. Step 5. What to avoid. Don't buy the first dip. Don't trade based on headlines. Don't go all in at one price. Don't follow crowd sentiment. The real edge. Most retail traders react emotionally. They sell into fear and buy into strength. You're doing the opposite. You wait for structure. You enter when institutions are accumulating. You use leaps to position for recovery. The edge is not prediction. The edge is patience and process. Final thought. Write this down. War begins. Markets react. Volatility increases. Stabilization forms. Then recovery follows. You don't buy during panic. You buy during stabilization. That's the playbook. If this framework helped you think about markets more clearly, hit the like button. It helps more people find this content. Subscribe if you want more structured strategies like this. And let me know in the comments, which phase do you think we're in right now? I read every comment. I'll see you in the next one.